Welcome to the 3-Edge Week in Review for the week of February 6th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here today once again is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I will be having a somewhat similar conversation to our recent discussion from a few weeks ago about echo bubbles, and today we'll look more closely at what's behind the rally in the equity markets that began last fall, and consider why the equity markets have rallied here in 2023 and what factors could put this current rally at risk. Before we get into that, let's take a quick look at this week's activity in the global capital markets, and it was a decidedly choppy week for equities. Tuesday was a great example. On Tuesday, the S&P 500 rose in the morning, declined in the early afternoon, only to rally back into the close. It was just that kind of week all week long in the U.S. equity markets. However, by the end of the week, it seemed as though perhaps the mood among investors may have swung a bit more towards accepting the potential for a longer period of tighter monetary policy and higher interest rates. But really what I'm seeing anyway, there seem to be quite a few disagreements among investors. Disagreements between the bond market and the stock market, disagreement between the stock market and the Fed. As one commentator put it, it appears as though the bond market investors are actually hearing what Jay Powell is saying, the actual words, while at the same time it seems as though the stock market investors have been hearing, all that they've been hearing are Jay Powell's words from his press conference in early February when he said the words, "Disinflation has begun." To begin the year, it seems as though equity investors are looking through or beyond the current situation to the time when inflation is back to around 2%, the Fed's target, and that will happen without the economy experiencing a recession. And another way to think about it is that you could say that the equity markets appear to be fighting the Fed and the way that they're positioning themselves and what they would describe as looking through what's happening now. The problem with that historically is that often doesn't end very well, Steve. So I will bring you in here, and maybe you could start today by just saying, okay, well, what are the factors that seem to be driving the equity markets higher here in 2023?
Well, Fritz, I think there are a few factors. One we talked about 2 weeks ago, as you mentioned, and that was the idea of an echo bubble, that whenever you have a massive market mania or stock market bubble like we had that ended at the end of 2021, you have an everything bubble, everything goes up, you have this euphoria, and then you have the inevitable decline, and we had that in 2022. And when we look at past bubbles, we find that often there's a nostalgia for the good old days when everyone had a lot more fun when the markets were going up. People get exhausted and tired of the downturn. And just based on crowd psychology, you start to see the formation of what we call an echo bubble. It happened after the crash of 1929. Market took a big fall, bottomed out in November of 1929. And then there was a major echo bubble all the way up until April of 1930. People thought, well, the bad times are over, let's jump in. And of course, much worse times came after that with the Great Depression. So right now we're having another echo bubble. Another reason why we're having a rally that actually didn't start just at the beginning of this year, but actually started in mid to late October. And that is what we call short covering, that there are a number of investors that bet against the market after having fallen quite an amount in 2022. And those short positions meant that they would make money if the market keeps falling, but they would lose money if the market starts to reverse. So when the rally started to hit, a lot of those short investors, those short positions, realized if they don't get out of their positions, they could lose money. So they bought back their positions, and that's equivalent to buying into the market. And that might be one reason why some of the stocks that got hit the most in 2022 rallied the most, because those were often the ones that the short sellers focused on. Another reason, right now in the market, there's this embedded inflationary expectation that inflation is going to come down to 2% very fast and stay there for the next 10, 20, 30 years. And we know that because we can subtract the 10-year Treasury bond yield and the TIPS yield, and that difference is expected inflation that the market is counting on. And if you believe that inflation is going to come down really fast, then you also believe that the Fed can start cutting rates much sooner than they say. That's a very optimistic scenario. And that's behind some of this rally as well. It remains to be seen if that is a fantasy or a reality, though.
Great. All right. So we have the rally, and it started in the fall, continued here in 2023. So now let's turn our attention to the risk to the equity market rally and what could happen to potentially derail this rally that we're seeing here.
Well, like past echo bubbles or like past bear market rallies, it's based much more on psychology in trend following and the fear of missing out than it is on fundamentals, on valuations, on economic factors. and that is true here. So by our measure, the stock market in the US was so overvalued by the end of the last market bubble. It was literally off the scale. And even though the market had a big hit in 2022, it went from extremely overvalued and by our measure to still highly overvalued. So any echo bubble or any rally that takes the market even higher is just bringing us into more overvalued territory. That's why we think there's a finite life to this rally. Now, because it's based in crowd psychology, it's hard to tell if the rally is going to be over in a day or two, or if it could last a few more months. Psychology can make any of those scenarios possible. One other catalyst also, though, is profits. We've had some profit announcements, some earnings announcements from companies. Some were better than expected, some were worse than expected. If the market starts to believe that the record high profit margins that the market's been enjoying for the last several months and even a few years is ready to go back to normal, that could make a big hit on the market as well.
Excellent. One other thing maybe you could comment is the yield curve. And I know that we measure the yield curve somewhat differently, but it seems to me that all over the map in the U.S. Treasury market, the yield curve is either quite flat or inverted. So maybe you could talk to that a little bit.
That's a really good point, Fritz. Every time there's a yield curve inversion where the short-term interest rates are a lot higher than the long-term interest rates, which is a very abnormal situation. But every time that's happened, we've gone into a bear market, we've gone into a recession. And I can tell you that living through several of these, every time it happens, the media starts coming up with reasons why this time is different. This time, there are unusual circumstances. This time, we're not going to have a recession. This time, look, everything's still fine. And all of those reasons are always wrong, but what they get wrong is that there's a long time delay between when the yield curve inverts and when eventually there's a slowdown or the next leg of a bear market or a recession. So I think you bring up a good point, which is that we've got an inverted yield curve. It hasn't been inverted for so many months. So perhaps everyone will think we've managed to escape by a recession. And then much later this year, it finally hits in a bigger way. So I think that's a good point.
Okay. My final question always is based on what we've discussed. How should investors think about positioning their portfolios in this situation? And it occurred to me that maybe investors feel like, they have to pick a side, we have to agree with the Fed or we have to agree with the equity market, and that's probably not exactly where you want to come down on this. So maybe just help us understand how investors could position themselves in such an uncertain period.
I think you bring up a really good point, which is in investing, you don't have to be extreme. You don't have to make a bet and say, well, this rally is going to be long lasting and it's the beginning of the new bull market. Put all your money in equities, because if you're wrong, you can get very hurt. On the other hand, you don't have to pick the other extreme and be entirely in cash. And in that instance, if the rally continues for several months, you start to feel a lot of pain of being left out. And then human psychology will tell you to, admit your mistake, put your money in. And of course, that could be right at the top of the market. So there is a very healthy middle ground that allows you to make return, but minimizes your risk. And that is to focus on those equity asset classes that are not overvalued, that have limited downside because they've underperformed and they've been undervalued, but still have some healthy upside because the valuations are compelling. And in some cases, the economic situations are improving rather than getting worse. And so what we've been advocating, and it's been working very well, is to stay very defensive in the most overvalued equity class, which is the U.S. market, and to tiptoe and have some modest allocations into non-U.S. equities that have better upside potential and less downside risk, like European equities, where the prices have come down so far that they already reflect so much bad news. And like certain emerging markets where before this rally started, some of those emerging markets were showing valuations near record lows, the opposite of the US that was showing valuations a year ago that were near record highs. The other thing is to recognize that the bond market might not be as safe as people think. It is true that the market expects inflation to come right down to 2%. And if you're buying a bond closer to 4%, it might seem like a pretty good deal, or 3.5%. On the other hand, what if the market inflation forecast is wrong? And history shows that the market is often quite wrong with inflation forecasts. What if inflation does come down from, it was, peaked at over 9%, it comes all the way down to 4% or maybe even 3.5%. But what if it sticks there and it doesn't come all the way down to 2%? Well, then all those bond investors are actually underwater, getting a rate of interest that doesn't even keep up with inflation. And you can think of that as a hidden tax. And so we would still be leery of major investments in the bonds. And one way to hedge against the equity market is to have some dry powder, some short-term treasuries, have some TIPS, Treasury Inflation Protected Securities, but also own some real assets that can do very well if inflation proves to be higher than what the market expects.
Excellent. Great. Thank you very much for your insight there. I think it was really helpful to go a little bit deeper into the echo bubble that we spoke about a couple of weeks ago. And this is not an easy market to get a handle on. And so, that's really one of the reasons that we make these videos, to try to help our clients to cut through all the noise in the financial media and just better understand what might be happening in the markets and why. So thank you, Steve. And that will do it for Steve and me for this week. As a reminder, all our videos are always on our 3Edge YouTube channel. You can go to YouTube and just type in 3Edge and you'll see our YouTube channel there. You see our videos. In addition, all our videos and all of our written comments are always available on our website. And our website is 3edgeam.com. And so, until next time, on behalf of Steve, everyone here at 3Edge, thanks for listening.